Hello everybody, thank you for joining us for our webinar this afternoon. My name is Brad Vorbeck, I'm with Turnkey Technologies, and we also have Neil McDonald from Binary Stream joining us. And Neil's going to be taking us through ASC 606 revenue recognition requirements. I just wanted to give a quick intro about Turnkey for anybody who isn't familiar, and then I'll go ahead and hand it off to Neil. Turnkey is a business solutions provider. We're based in St. Louis, Missouri, and we're primarily focused on ERP, customer engagement, as well as Office 365, Power BI, managed IT services, and hosting, cloud hosting services. And we partner with Binary Stream to extend our customers' ERP systems to handle things like subscription billing, advanced contract billing, multi-entity management, and lots of other extensions. So I just want to thank them again for presenting today's webinar with us and for sharing this timely information. If you have any questions, do feel free to ask them during the webinar. We will go ahead and get them answered at the end in a Q&A session. And also this is going to be recorded, so we will send that out to you in a follow-up email, so you'll have that as well. So yeah, thank you again everybody for joining us. And Neil, would you like to go ahead and take it away?
Okay, thank you, Brad. Appreciate that. So welcome everybody. Yeah, as Brad mentioned, we're going to talk today about ASC 606. It is a new revenue recognition standard that, depending upon whether you're a private company or a public company, you may already be looking at being late. You may have a little bit of time to prepare for it. We're going to talk about timing as we go through the webinar. But let's jump right in and talk about ASC 606. First of all, again, my name is Neil McDonald. I work for a company called Binary Stream Software. I am a CPA. I am a CMA, project management professional. I've been doing this type of business for about 35 years. Been in project management, IT management. Previously, I was a manager of IT and process improvements for EDS Canada, being a national delivery manager. For the last 10 years or so, I've been involved with Dynamics GP, currently as a solutions consultant with Binary Stream Software. One thing I do want to point out really quickly, although I am a CPA, I am not your CPA. So while I'm going to cover ASC 606 today, make sure that you take what you learned today back to your office, back to your CPAs, and talk about exactly how it applies to you. The legislation is very long. It's about 200 plus pages if you download from the FASB website. If you're under IFRS 15, which is the International Financial Reporting Standards equivalent to ASC 606, it's about the same, but there are some differences. When you get the slide deck later, I've actually got some slides that I'm not going to be presenting today. There's 10 major differences between IFRS 15 and ASC 606, which is in the slide deck. Again, we're not going to have time to cover those. Make sure you do your homework. Just because I'm a CPA doesn't mean that what I'm telling you is necessarily what your auditing team, what your CPA is going to take as the proper interpretation. So why are we here today? We're going to learn what ASC 606 is, and we're going to learn how to handle revenue recognition under ASC 606. There's a very definite 5-step process that you need to follow. We're going to go through those 5 steps in great detail and then show you some examples of how you can handle ASC 606 in Dynamics GP. Of course, it doesn't really matter what your ERP is. The ASC 606 is the same, but how do you do it if you're a GP user? And I'm going to talk to you a little bit about a product or a suite of products that Binary Stream is offering that can help simplify your implementation, help simplify your ASC 606 compliance. So from an agenda standpoint, again, what is it? What's the 5-step recognition model? In implementing ASC 606, is there anything that you really need to be worried about? Are there any gotchas, areas of concern? And then again, we're going to talk about the hard way and the easy way to be compliant in Dynamics GP. Now, I typically do this live, and I've got in here, ask questions anytime. You can't literally ask the questions, but certainly feel free to type them into the GoToWebinar panel there. And Brad, if a question comes up that looks really relevant to what I'm talking about at the time, feel free to interrupt me. I'll be more than happy to answer it. Otherwise, we'll do Q&A at the end. Sure. So ASC 606, you may also hear it referred to as ASU 2014-09 or IFRS 15. Let's look at what it is. Basically, it's a brand new or an updated accounting standard. It's been coming for a long time. FASB and IFRS have been working on it for about 10 years. They released it about 2.5, 3 years ago to give everybody time to get up to date. But basically, it's a new standard that's been released to replace almost all of the other revenue recognition standards, with some minor exceptions, leases, insurance, and banking. But the idea was, under the accounting standard is to make it so that everybody is subject to the same rules. Everybody's subject to the same set of revenue recognition standards. And that's really important if you are an investor, if you're a banker looking to support a company, or someone looking to put their money into it, buy shares in a public company. Because under the old standards prior to last year, depending upon what business you were in, there were different rules. Therefore, if somebody was to look at your financial statements and compare them to somebody in a different geography, in a different industry, in a different market, they would have to know both sets of rules so that they could do the comparison and compare, is your company more profitable? Is it a better investment than company A or company B in one of those other markets, geographies, and so on? Under ASC 606, everybody's on a level playing field. So now someone can look at a set of financial statements from your company and look at some other company in some other geography and know that you're playing by the same rules. The revenue recognition should be consistent if everybody's compliant. Again, except for leases, insurance, and banking, there's new standards for those as well. But everybody's now on the same level playing field. It's going to replace, or has replaced, a lot of the standards that you may be using currently today, EITF 08-1 or 2009-13. If you're in the software industry, SOP 97-2 is probably something that you live by. Well, it's gone away. It removes the reliance on things like vendor-specific objective evidence, third-party evidence in determining those fair values. There's something similar, so it hasn't completely gone away. Those terms are no longer there. But some of the principles have gone away, but we're going to touch on some similarities as we go through this webinar. It adds some new terms and new elements that we have to get used to going forward as well. It talks about performance obligations. Today we recognize, or previously we were recognizing revenue based on deliverables. Deliverables don't matter anymore. It does not matter when you deliver something. It's when you have fulfilled your performance obligation. We will talk about that in more detail. It requires distinct identification of the performance obligations in your contracts as well in order to recognize the revenue. It adds a couple new features, variable consideration. There's two of those. We'll talk about those. And it also adds the time value of money for certain contracts. So if the timing of the performance obligation being fulfilled and the cash payment significantly differ, there's a time value concept there, and an interest component comes into play. And now recognition does not depend upon, hey, I've delivered the stuff, but it's based on transfer of control, and it's very specific as to what constitutes control. One of the things you'll find as we're going through the webinar today, under the previous standards, there was a lot of rules. If you read through the old accounting standards, there was a lot of you must do this, you must do that. ASC 606 is principles based. So there's a lot of judgment required on your part. What that means is that you, your accounting team, really need to understand ASC 606 and the requirements of it, or those principles, so that you can make the right decisions. Also, because it is principles based, it allows you to make judgment calls and decisions. It requires much more extensive disclosure in your financial statements. If you make a judgment call on something, you have to justify it. You have to put it in the disclosures to your financial statements to say, we made this decision because, and outline it very clearly. So we talked about the 5 steps. What are they? First of all, we have to identify, do we have a contract with a customer? Is it a single contract? Is it multiple contracts? Do multiple contracts in fact constitute a single contract? We have to identify within our contracts the performance obligations, determine the transaction price for each performance obligation. Then, based on each performance obligation's standalone selling price, in step 4, we have to allocate or maybe even reallocate the revenue. And then number 5, we're going to recognize the revenue upon satisfaction of the performance obligation. Let's go through these one at a time. Let's identify the contract. Under ASC 606, a contract is defined as an agreement between 2 or more parties that creates enforceable rights and obligations. Notice that this is revenue from contracts with customers. It does not apply to any other type of a contract. For example, a partnership contract. It's only contracts with customers. There are other rules for contracts like partnerships. In order for an agreement to be a contract under ASC 606, it must have commercial substance. It must be approved by all parties. Now, what does that mean, the approval? ASC 606, the documentation is actually very broad in that. And basically it talks about your customary business practices. So for example, it may be your customary business practice to require a purchase order. Maybe you actually have to sit down with a bunch of lawyers and hammer out a 90-page contract, and everybody's got to stamp it and sign it. That's your customary business process. Some parts of the country, you know what, a gentleman's handshake is a contract. Whatever is customary in your business. The contract or the agreement must have identifiable rights regarding the goods or the services. What are the goods and services? Who owns them today? Who will own them tomorrow? At what point do they transfer from you as the vendor to your customer? All of that must be outlined in the agreement. The agreement must have specific payment terms. If there are not specific payment terms, then it does not qualify as a contract under ASC 606, and there's other rules that would come into play. It must also have a probability of collection. It gives a threshold in the documentation of about roughly 70%, give or take. And it may be that your customer may have given you cash, but you're not sure you're going to be able to collect the rest of it. You may not be able to be satisfied for your end of the contract. Therefore, even though you've got cash in hand, you cannot recognize the revenue. So all of these things must be in place. So the way you write your contracts may change under ASC 606 as well. If all of these are not in place, then you may be forced to, even though you have cash in hand, not recognize any revenue until such time as that agreement has been completely satisfied. ASC 606 also talks about contract modifications. If something changes, a contract is extended in time, new goods or services are added. Maybe it's seat licenses, for example. You're offering a certain price for seat licenses, and 2/3 of the way through the contract, your customer or your sales guy come up with some new and wonderful arrangement to buy more licenses for a longer period of time at a lower price. That might result in a brand new contract. ASC 606, the documentation from FASB, has about 65 examples in Appendix A. Read through those. Some of those might apply to your business, but there's all sorts of scenarios as to what may or may not happen. How can you recognize revenue? What creates a new contract? ASC 606 also talks about multiple contracts that are entered into at or around the same time or that are dependent on one another. And it says if that is the case, you may have to treat those as a single contract. So for example, you can't have a contract for item A and for item B with different terms if they are dependent on each other. Let's say I sell you hardware on one contract and software on a different contract. Well, you could use the hardware without the software, but it's kind of hard to use software without the hardware, especially if it's proprietary software. So even though they're written on two different documents, signed at different times, if they are dependent on one another, you have to treat the revenue from those contracts as if they were a single contract. In other words, when you reallocate the revenue, you have to look at them as if they were a single contract, not multiple seemingly unrelated contracts. Are the contracts negotiated separately but with a single commercial objective? That's really kind of what you have to ask yourself when it comes to deciding, does this apply to me or not? Does the consideration for one contract depend upon performance of another? I can't fulfill contract B until I fulfill contract A. Maybe they're that dependent. Treat them as a single contract. So we've identified that we do in fact have contracts. We've gone through our documentation, we've looked at our contracts, and yep, these qualify. Now we have to identify within those contracts the performance obligations. A performance obligation is a promise, whether explicit or implied, in a contract with a customer to transfer goods or services. It might be a single good, a single service, it might be a combination or a series of them. It might be a one time, it might be over time. If a contract consists of more than one good or service, you account for them separately only if they are distinct. And ASC 606 is very, very clear about that. The performance obligations must be distinct. What does that mean? It means the customer can benefit from the obligation on its own or with resources readily available to the customer, and each obligation is distinct in terms of the contract. In other words, if somebody was to walk into your business off the street, they don't know what you do, and they were to pick up one of your contracts, could they look at that and determine that there are multiple performance obligations? Or is there, the way it's written, it looks like, you know, you're just providing a service, and that service happens to be a whole bunch of things. You know there's multiple performance obligations, but if it's not distinct in terms of the contract, then you may have to account for the contract as if it was a single performance obligation. Here's an example. Suppose you have a contract to sell to somebody a system. In your mind, you know that system is hardware, software, and a service contract. But the contract in writing simply says, we're going to supply you with this computer system. Now, that service contract is deferrable. But if it is not distinct in terms of the contract, you may be forced to defer the entire contract. That means you can't recognize your hardware revenue up front. You can't recognize that software revenue up front or over time differently from the service contract. So you have to make sure that your performance obligations are very distinct so that you're not harming yourself as far as your revenue recognition and the timing goes. And of course, that plays into your profitability at the end of the year when someone's looking at your financials. Is there an implicit promise for additional goods or services? You know, that could be a separate performance obligation. It may even result in deferred revenue. It may result in an entirely new contract. Again, 606 is very explicit. So we've looked at our contracts. We know we have them. We've gone through and we've determined that there's performance obligations. Now what we have to do is determine, does our contract spell it out? That's even better. But what is the transaction price for each of those performance obligations? The transaction price is the amount of consideration to which an entity is entitled for transferring those goods or services to the customer. Notice that this must be determined at contract inception. This actually is one of the differences with IFRS. IFRS 15 allows you to determine that value, that transaction price, later on. You don't have to do it at contract inception. You could do it sometime later, and again, it details what that means. But under ASC 606, under the FASB regulations, you must determine that at contract inception. And you would reassess that at each reporting period. So if you're reporting publicly quarterly, you would reassess that either on an individual contract basis or on a portfolio basis, that your transaction prices are indeed what you have said they are. It talks about variable consideration. Again, we mentioned that this is new. What does variable consideration mean? It means one of two things. It could be a most likely amount, for example, all or none. I'll share with you an example here in just a moment, or the estimated or expected amount, which is the sum of the probability weighted amounts or averages. Here's an example. If you look in the ASC 606 literature, as I mentioned in Appendix A, there's about 65 examples of different revenue recognition scenarios. Example 21 talks about a contract where you're building something for somebody. The contract is for $250 million plus or minus $10,000 a day, whether you're early or late. Then at completion, you would have an inspection and you will receive a bonus of $150,000 if you pass the inspection. So you may be recognizing your revenue based on a cost plus type of scenario. When you're doing that cost plus or that fixed price, however you're working it, and you're looking at how much revenue do I recognize as I'm going through this contract, it says there's two pieces here. It is a single performance obligation, but in this case, it has two variable amounts. The first one look at the expectations and use the estimated revenue associated with that plus or minus 10,000 a day. Well, how do you do that? If this is a brand new contract, you probably want to play it very conservatively and maybe not look at that plus or minus at all. Maybe just focus on the 250 and change down the road. But if you've done this many, many times, your business is to build whatever this thing is, and you've done it so many times and you know that you're consistently coming in 10 days early, then you can assume, based on those expectations, an additional 10K for those 10 days. Maybe you average it out. But again, this is where some of that judgment call comes in. It's a principle, not a rule. But when you make that decision, document it. Disclose it in your financials. Variable amount number 2 is that bonus. It's either all or nothing. Again, based on your history, based on what you know, will you get that bonus? Again, if this is the first time you've ever done it, personally, I play conservative, say, you know what, I'm not going to worry about it. I'll be a hero down the road and recognize it later. But if I've done this 10, 15 times, and every single time I get the bonus, there's a really good chance I'm going to get it again, and I can throw that in my revenue recognition. Again, judgment call, disclose it, document it. We mentioned earlier about the time value of money as well. This also is new. Basically what it says is if it is significant, the amount, and if the timing difference between the performance obligation being fulfilled and the receipt of the revenue is greater than 1 year, then it has to be treated as a loan. And there's going to be an interest, income, or expense component there. So if a customer pays you today for something that you're going to bill and deliver to them in 14 months, well, that's like they've just loaned you money. Again, and that's if the pricing is different based on whether they pay now or pay in the future. You have to treat that as a loan, do the net present value calculations, and build out that interest component. Again, this is only for contracts greater than a year and only if the amount is significant. Well, what does significant mean? What's significant to me might be different than what's significant to you. So again, you would have to define that and disclose that as to why you've made that decision. An example, suppose that your average contract is less than a year, but is greater than $50,000. And now you get this 2-year, $2,000 contract. In my mind, that's insignificant. 2,000 versus 50. No, someone else might say, no, that's still a significant amount, and they may treat it as a loan. Entirely up to you. Document it, disclose it. What rate do you use? ASC 606 doesn't tell you, other than to say use the prevailing rate in your industry. ASC 606 also talks about non-cash consideration and says they should be treated at fair value at contract inception. So suppose you do work for another company, it's a startup, and you say, you know, rather than pay me cash, give me 1,000 shares in your company. Well, you have to determine at contract inception what the value of those is and recognize the revenue accordingly. If that company gets wildly successful and takes off, that's not a change in your sales revenue. It's actually a gain, or if it goes under, a loss to operations. So again, those non-cash things determine the fair value at contract inception. Changes in fair value is a gain or loss to operations, not an increase or decrease in revenue. There's also a section that talks about consideration payable, such as rebates. There's a whole section on that. If that applies to you, look that piece up. Again, it says to treat that as a reduction in the revenue unless it's for a distinct good or service, in which case you could apply it directly to that good or service. Okay, so we've gone through. We've got contracts. We've got performance obligations. We've looked at the contract the way it's written. We've determined what the transaction price is for each of those performance obligations. Now we have to allocate those transaction prices. Well, didn't we just do that in step 3? Not necessarily. The transaction price is the allocation is based on the standalone selling price of each of those performance obligations. The standalone selling price is the price at which an entity would sell a good or service to a customer absent all other goods or services. And if it is not directly observable, at this point you would have to estimate it using different methods, maybe market factors, cost plus margins, that kind of thing. This was almost like the SOE. So I mean, while the term has gone away, the principle there is not necessarily gone. I mean, looking at market adjustments or market assessments, that's kind of like the third-party evidence. So while again, the terms are gone, the principles and the thought process that you would go through are still there to a certain extent. So under ASC 606, we're no longer talking about fair value. We're talking about standalone selling price. Notice the second bullet on this. This is taken directly out of and quoted from the ASC 606 literature. We just went through and figured out what the transaction price was in the contract. But notice it says that a contractually stated price may be, but shall not be presumed to be, the standalone selling price. Well, what does that mean? Suppose we have an item that we've determined has a value to a customer of $10,000. But at the same time, our sales guys can go out and negotiate the best deal. So one sales guy sells it for $8,500, another one sells it for $9,500, another one sells it for the $10,000. Another guy says, you know, I'm going to charge $11,000 and I'm going to throw in a one-year service contract. All of a sudden now it's not so clear. So the transaction price could be different on every contract, which means that level playing field that we were looking for at the very beginning is kind of murky. The standalone selling price of that item, however, is $10,000. So even on the contract that we sold it for $8,500, the contract that we sold it for $11,000, it still has a standalone selling price of $10,000. Getting confusing yet? I'm going to show you an example to help clear it up. Here's an example. Suppose I'm selling this computer system. I'm going to sell it for $1,000, but I know that if I were to sell each piece of this contract, each performance obligation separately, it has a standalone selling price as outlined here. The CPU of that computer, $700. The monitor, $300. The keyboard and the mouse, $100, and that service contract, $100. If I were to sell each of those items, absent all the others, this is the standalone selling price. This is what I've determined them to be. Now, I'm going to sell that for $1,000, but notice they add up to $1,200. How do I allocate the revenue? The formula is we take the item's standalone selling price, we divide it by the sum of all the standalone selling prices, and then we multiply that by the actual contract value or the selling price of this contract. So for example, that CPU has a standalone selling price of $700. We divide that by the $1,200, which is the sum of those SSPs, and that says that's the relative value of that item in this contract, which we're selling for $1,000. So the revenue allocated to this thing, this CPU, is $583.34. And we do that for every item so that by the end of this, we have actually allocated the full $1,000. The one that really makes a big difference here is that service contract. It's $83.33. It is a deferred item. I can't defer $100. I can only defer the $83.33. So there is a difference in the amount that I may want to or I may have formerly deferred versus what I can defer under ASC 606. And you're looking at that going, you know what, it's 16 bucks and change. Who cares? Well, what if you have 10,000 of these? Or let's add 3 or 4 more zeros on the end because your contracts are significantly larger. All of a sudden now it makes a huge difference in your contract because you could be misrepresenting your financials to the tunes of thousands or tens of thousands or hundreds of thousands of dollars, and the timing may be wrong. Now, bear in mind that if these performance obligations are not distinct on the contract, then we have to treat the entire contract as a single performance obligation, meaning we may have to defer the entire $1,000. That can really put a damper on your financials at the end of the year because instead of recognizing the bulk of this thing up front, I've got to defer the full amount. So you notice that the reason that we have to do this is so that under ASC 606, we're recognizing the correct amounts at the correct time. Okay, so we figured all that out. Our contracts, our performance obligations, our transaction prices. We've taken the standalone selling prices. We've reallocated the revenue. Now, when can I recognize the revenue? ASC 606 says I can recognize the revenue upon satisfaction of the performance obligations. Well, what does that mean? It says that we can recognize upon satisfaction of a performance obligation by transferring a promised good or service to a customer. A good or service is transferred when or as the customer obtains control of that good or service. And then it defines what that control means. We're going to get into that in just a moment. Notice that you can satisfy this at a point in time. It may be, at a certain point in time, you can say, yep, the customer has control, everything's good, recognize the revenue. It may be over time. A service contract is a great example of that. You're obligated to that customer for 12 months or 24 months. You can only recognize the revenue 1/12 or 1/24 each month as you go forward. It may be a contract that's written in such a way that has milestones that you're going to recognize only when milestones are hit. It also talks about how it can be satisfied over time if the performance creates or enhances an asset over time and the customer controls it as it is created. An example that might be if you're in the landscaping business. Maybe you're going to do a landscaping job for a customer and it's going to take you the whole summer to do it. Well, does that mean you can't recognize any revenue until the customer pays you at the very end? No, that would look really weird on your financial statements. But if you're enhancing it over time and the customer has control of it, you could recognize revenue. Maybe you do a cost plus margin until you get to the end and you can true everything up. Or maybe the performance does not create an asset with an alternative use to the entity providing the good or service. An example of that might be a construction contract. Maybe you're in the construction business, somebody approaches you and says, hey, can you build me an apartment building or can you build me a mall? Well, obviously you're going to recognize your revenue over time so that you show profitability. And at the end of the day, that mall has no alternative use to you. I mean, that's not your business. You don't run malls. You don't run apartment buildings. You build stuff. So that's another one of the ways that it can be satisfied. Or it says the benefits are received or consumed as the performance takes place, the service contract we mentioned earlier. And again, it could be straight line. It could be milestone event-based, percentage of completion, cost plus. There's many ways that you could come up with how to recognize this over time. Bottom line is it's as the customer gains control. What does that mean? The customer gains control when all 5 of these are present. These are not mutually exclusive, or they are mutually exclusive, sorry, they must all be in place. The customer has a present obligation to pay. The customer has legal ownership or title of that performance obligation. The customer has physical possession, enjoys the risks and rewards of ownership. This is the last one that is really hard. The customer accepts the performance obligation. What if in your mind you think you're done? You've done, the other 4 are there. You've finished it, you've delivered it, the customer has it in their possession, they're enjoying the benefits of it, they've got an obligation to pay as far as you're concerned, but they turn around and sue you for something because they're not happy. Bullet number 5 is not there. You can't recognize the revenue. This is a tricky one. I'm not sure I particularly agree with that one, but this is what ASC 606 says. All 5 of these must be in place. So those are the 5 steps. We're going to identify our contracts with our customers. We're going to identify the performance obligations, determine the transaction prices, allocate the revenue based on the standalone selling prices, and then recognize the revenue upon satisfaction. So, you ready to go? Thinking about ASC 606, what do I need to know? What do I need to worry about? What if we don't do anything and something magical happens? I guarantee you something magical is not going to happen. You must start to adopt. You must get ready. You must start to implement. So let's talk about what you need to know. What is the timing? If you are a public company or most not-for-profits, then ASC 606 is effective for fiscal periods beginning after December 15th, 2017. In other words, 2 months ago, 3 months ago now. If you are an IFRS 15 follower, it's actually January 1st, 2018. There's that 2-week timing difference there. But the bottom line is, if you haven't started and you are a public company or a not-for-profit, you're already too late. You've got to get going and get going quickly. If you are a private company, you get till the end of this year to implement. Now, you can adopt early if you want to. If you're ready to go and you've already adopted, that's great. You're fine. But again, you must be ready by the end of this year. Watch how your contracts are written. If you are selling solutions that include multiple performance obligations and yet they are not distinct in terms of the contract, you may be hurting yourselves from a revenue recognition standpoint. You may end up having to defer the entire contract, which again can hurt your profitability. So items sold as part of a solution may need to be deferred till the end unless they are distinct in terms of the contract. What about materiality? Even if an item is distinct, if it is immaterial, you can elect to combine it with another associated performance obligation. That's always been a principle that us accountants like, right? The materiality. Nobody's going to spend time hunting for that missing penny. Going to do an adjustment and move on because you could spend hours trying to find that penny. Same with this. If you've got, for example, $1 million contract and it's got one extra performance obligation that's worth $50,000, but it's closely related to another performance obligation, you might decide, you know what, $50,000, that's immaterial in terms of this contract, especially if I've got many of these, and you decide, you disclose that $50,000 is immaterial from a revenue recognition standpoint, and you roll it in with something else. There's an entire section in 606 on licensing. One of the things that you should look at there is the difference between right to use and right to access licensing. They are treated differently depending upon what type of licenses you're selling. They recently issued a release updating this, and they went from right to use. They said, you know, that's functional IP, and gave some examples. Software, drug formulas, media content, that kind of thing. And ASC 606 says that type of IP can be recognized at a point in time. That is a huge departure from SOP 97-2. It used to be that if you were selling software, you had to recognize all of the other components first and then use the residual method and recognize the revenue for the software sometime later, maybe even defer it over the life of the contract. This is a huge difference for the software industry. The right to access licensing or symbolic IP would be recognized over time. That's things like brand names, team names, logos, that kind of thing that you're licensing either to somebody or from somebody. The timing of that would be spread over the life of that contract. ASC 606 also says that each reporting period, you have to review your contracts to make sure that they do in fact still qualify as contracts under ASC 606. Make sure that all of those things are in place that allow you to recognize the revenue. Is there still an obligation to pay? Is there still the probability of collecting? That kind of thing. You can do this individually, contract by contract, or if you have an entire portfolio of related contracts or very similar contracts, you could elect to do this by portfolio. It also talks about not just the contract, but the performance obligations being reviewed periodically as well. And I downloaded a paper from RSM. They're a large accounting firm in the US, and the link is there at the bottom if you want to download it. It's the RSM Financial Reporting Insights for September 2017. The link is here. When you get the deck, you can download and read this document. But it talks about 5 key considerations. And one of the things that, number one, that they talk about there is that while we're talking about accounting, this is not strictly an accounting function. So if there's people in your business that don't know about ASC 606, you might want to get them up to speed as well. But you know, they're not the accountants, who cares? Well, what about the tax department? What about the C-suite? It's going to make a difference in what their financial statements look like next year and the following year compared to what they looked like last year. There's some material changes that may show up in their financial statements. Their ability to make decisions going forward means that they really have to understand why those things changed. What's different? What caused that to happen? They need to understand ASC 606. What about the folks that write your contracts? The contract department, maybe it's your legal department. They have to understand that the way they write contracts is going to severely change the way that you recognize revenue. Are those performance obligations distinct? Are all of those things in place that talk about the consideration and the timing and when control changes from one to the other, that kind of a thing? What about your IT department? We're here because you all use Dynamics GP. Is your ERP ready to go? Does your IT team know what they have to do to make it so that you as accountants can be GAAP compliant under ASC 606? This is an adoption that requires the entire company be up to date. Number two, in 2017, they were saying the required implementation dates are fast approaching. If you are a public or not-for-profit company, they're not fast approaching, they're gone, and you're already running behind. So again, that's going to require a lot of catch-up effort on your part. The method of adoption has a significant impact on the level of effort. There's two ways to adopt ASC 606. One is a full retrospective, which means that on the day you adopt, you have to restate all currently open contracts and restate your last prior 2 years of financial statements. Now, you don't refile with the government, but you have to restate and say, you know, here's the current year, here's last year under ASC 606, and the prior year under ASC 606, so that you've got that 3-year comparative. The modified retrospective simply says, in the current period, here's what I look like, and line by line in your financials, you have to state what the change was. You know, under the old method, it would have been this number. Under ASC 606, it's this number. And you have to go line by line down your financial statements where there is an impact from 606, and you have to be able to explain those. The modified retrospective, the downside of that is that there's no year-over-year comparison, because you're simply saying, as of today, here's the change, and here's my disclosures. So if you want the ability to do those year-over-year comparisons, you need the full retrospective. Either way, it is a pile of work. And that's step number 4, item number 4 here. That 5-step approach does require a significant amount of work. And in number 5, it says revenue recognition is only the beginning. There are other accounting changes coming. ASC 842 talks about leases. And under the leasing, if you are a lessor, in other words, receive revenue from leases, not only do you have to change because of ASC 842, but your revenue under ASC 842, there are times when it says, and recognize the revenue according to ASC 606. It's right in the ASC 842 documentation. So there's some overlap there. A lot of changes coming, a lot of key considerations according to this RSM document. So we're here because we're running Dynamics GP. How do I do all of this in Dynamics GP? How do I make sure that I am 606 compliant? You can't, not really, not easy way, but I'm going to show you 2 ways that you could do that. You could do those 5 steps in Excel, or you could do those 5 steps with an ISV solution. I'm going to talk about both of those very quickly here. Let's look at Excel. If you were going to do this in Excel, you have to basically take your contracts, divide out your performance obligations, figure out the transaction price, figure out the standalone selling price, then do that calculation that we talked about, and then recognize the revenue as you do your billing. That's time consuming, it's complex. If you've got more than just a handful of contracts, what a waste of your time. There's other things you could be doing that are more important. Let's walk through an example. This is a very easy one. I'm going to sell these to a customer. This is my contract. I'm going to sell hardware, $15,000. I'm going to bill you once. Setup fee of $5,000, billed once. I'm going to have some SaaS or software as a service software. I'm going to bill that monthly, $7,000. I have an annual maintenance contract. This is a 2-year contract, so I'm going to bill it twice, once up front, once at month 13. I'm going to defer that over the 12 months. I've also got some professional services. I'm going to bill them up front. I'm going to recognize them over time as those hours are used. And my sales guy has thrown a discount on this. So this contract is for $41,000. Over the life of the contract, the 24 months, it comes to $214,000. So far, it's pretty easy. That's easy to do in Excel. Now I have to go and I have to determine the standalone selling price. So that hardware, even though I'm selling it for 15, it has a standalone selling price of 17. My setup fee, going to leave it alone. The software, my sales guy is giving them a deal there too as well, because it's got a standalone selling price of 8,000, and then everything else stays the same. So my contract standalone selling price is $241,000, yet my contract value is only $214,000. Now I have to reallocate the revenue. When I do that, here's the revenue I can recognize each period. That $15,000 hardware actually has $15,095.44 worth of revenue associated with it. The setup fee for $5,000, notice that it's only got $44,3983 as revenue allocated to it. My software, $71,0373. My $12,000 contract, that's the deferred piece, I can only recognize and defer $10,655.60 for that service contract, and so on and so on. I have to do this for every performance obligation in every contract. Again, remember the formula. We're taking the item standalone selling price, dividing it by the sum of the standalone selling prices. So for example, the software, the 192, divided by 241. We're going to multiply that by the contract value of 214 to give us the $170,489.63. Divide that by 24 months. I've got periodic revenue of $71,0373. Now, almost anybody could build this in Excel, right? If you've got one contract, not bad. You got a dozen, not bad. What if you have hundreds or thousands of contracts and they have varying different items, performance obligations, with different amounts and so on them? All of a sudden you realize this is a pile of work, because now let's go to the next step. When I invoice, so the first two columns on the left are my invoice. My customer's going to see a bill for $41,000. What the accountants are going to find in the back office is column 3. They can only recognize $39,958.50 worth of revenue. Therefore, somebody has to go in behind that invoice, adjust the distributions, and notice at the very bottom on the right-hand side, those last two columns there, that contract revenue clearing account, I've got to accrue that additional revenue of $1,041.50. And each month, I have to do the similar calculation. Now, by the end of the contract, the end of 24 months, I will have billed and recognized the full amount of the contract, because that clearing account is going to go debit, credit, all the way through until eventually it zeroes out. However, I have to make sure that at each reporting period, and if you're a public company, that could be quarterly. For most other companies, it's at least annually, that you've got the correct amount of revenue billed and recognized. So again, can you do it in Excel? Absolutely. Do you want to? Again, I can't answer that question, but if I had more than a handful of these, I wouldn't want to be doing this. So what's the other solution? I work for a company called Binary Stream Software. That's part of the reason that Turnkey has invited me here today to talk about ASC 606, but also to tell you how they can help make your life easier. And they do that by introducing ISV partners. We produce add-on modules for Dynamics GP. We also have them for NAV or NAV, and for Dynamics D365 or AX. So everything I'm going to talk about is available with all of those platforms. However, we're going to focus on GP today. We have a subscription billing suite. It consists of 3 major components. There's the advanced recurring contract billing. That will allow you to create a contract that has one-time billing, that has monthly, weekly, daily, quarterly, whatever billing frequencies you want, and bill those accordingly. We have an advanced revenue and expense deferrals module. So for those items that are deferred, as you bill them, we can automatically create the deferral schedule behind that contract, behind that invoice. You don't need to take that out to Excel and build yet another schedule to build that waterfall or that deferral schedule. And then we have the piece that kind of ties it all together, the multi-element revenue allocation. That's the piece that's going to reallocate the revenue. It stores the standalone selling price. It looks at the contract and says, hey, you know, I know what the contract price is, I know what the standalone selling price is, and I know the formula, so I'm going to automatically do that in the background. A little bit about each of those modules. The ARC-B, the Advanced Recurring Contract Billing, can do scheduled billing, so January, February, March, April. It can do milestone billing. So I'm going to bill you 10% up front, I'm going to bill you 30% at this milestone, another 20% at that milestone, and so on. You have line level control of the billing parameters. So that contract that I showed you with the hardware and the software and the one-time items and the monthly items and the annual items, simple. Do that at the line level. We can also do metered or consumption-based or usage-based billing. We have true tiered pricing. We have cumulative pricing. We have free quantities. We have minimum and maximum commitments, a whole range of advanced pricing options available, and it fully integrates with the next piece, the advanced revenue expense deferrals. It again does either straight line or milestone revenue recognition. 12-month contract, January, February, March, it divides it by 12, done. We also have milestone recognition. So maybe you have in your contract that says you're going to recognize a certain amount of revenue when a certain thing happens. Maybe your revenue is based on providing a service, for example, at hockey games. You have X revenue for the season. You're going to recognize a certain amount of revenue when those games happen, right? You can't really plot those nice and neatly January, February, March because you could have multiple games in 1 week, none for a couple weeks, that kind of thing. We can do that milestone recognition as well. We're doing that recognition at the line item level, not at the distribution level. So you don't have to go in and manipulate the distributions. You do it at the item level, or we do it at the item level. You don't need to allocate templates and profiles and split up distribution amounts manually to do that. We also don't post to future periods. There are other ways to do revenue recognition in GP, the GP RED module. Great module for what it does. One of the things that some accountants don't like, me included, is it likes to post into the future. If I have a 5-year deferral, it will create 60 journal entries and post them today. We'll build a schedule for 60 months so you can still forecast on it and review it and look at it and see, you know, what are you going to recognize this month, this quarter, next year, so on. But we don't post to future periods. We let you be in control of what gets posted and when. And of course, it fully integrates with the advanced recurring contract billing. The last piece is the multi-element revenue allocation. We're going to set and define the standalone selling price, or what we used to call the fair value. We're going to create the allocation. You say, you know, on this billing schedule, treat all these items as if they belong together, and then automatically reallocate the revenue. This is a screenshot that matches that Excel spreadsheet that we just built. I didn't have to build anything here. I just had to drop these items on the contract and then come in and say, treat them as if they're all, and you look at the 1, 2, the 4th column under MEAID, they're all treated as if they belong to contract 1. And it says, great, I know the formula. I'm going to pull in the fair value or the standalone selling price. I'm going to allocate the revenue. Now when we create the invoice, we have the revenue amounts, so your customer gets billed the correct amount, the back office sees the correct amount on the distribution, and we pick up that extra piece that needs to be accrued over the life of the contract. It happens automatically in the background. Some other features that we're working on, some have already been released, SSRS reports, things like monthly recurring revenue, which we also have as a Power BI dashboard now, contract value reports, termination reports, revenue waterfall reports, deferral balance reports. There's all kinds of rich reporting as part of the application. We actually have an entire quote to cash system that allows you to start, for example, in CRM. We built the eConnects to push that information from CRM into Dynamics GP, into the advanced recurring contract billing. And then on the back side of that, we have a portal where your customers can self-serve. They can log in with an ID that you give them. They can see their contracts. They can see their invoices. And with a simple click of a button, they can pay them. We're using the Notice Pay Fabric piece to integrate there to allow your customers to pay. We have revenue allocations that say you can split one item into several performance obligations across multiple deferral or recognition accounts. And again, as I mentioned, we have those connectors, the eConnect nodes already built to connect with your CRM, whatever that front end happens to be. There's multiple different systems out there. So quickly running out of time, we reviewed ASC 606. We looked at the 5-step recognition model. We talked about 2 ways that you can handle this inside of Dynamics GP. You can do it in Excel. It's a great tool. I don't personally believe that it's meant to be used for that. It does some great things, but that's a lot of work. Billing your billing contracts, reallocating your revenues, recognizing your revenues, building your deferral schedules. That's a lot of work in Excel. We also talked about the binary stream solution, the advanced recurring contract billing, advanced revenue expense deferrals, the multi-element revenue allocation. If you want more information, Michelle's information is here on the screen from Turnkey. Pick up the phone, give her a call, send her an email, log on to the website, turnkeytech.com/contact, and send in your information. If you want more information on ASC 606 itself, my information is here on the screen as well. Certainly feel free to drop me an email or give me a call. I'll be more than happy to talk to you about it. That's all I've got. Brad, I'm going to turn it back over to you just to see if there's any questions out there.
Hey, Neil, thank you. No, we don't have any questions submitted at this time. Did you have anything else you wanted to add to the webinar before we go ahead and wrap it up?
I guess the only other thing I would like to say there, Brad, is if anybody wants to see those products in action, at Binary Stream, we have 2 solutions consultants, myself being one of them, Don Ramsey being the other. We would be more than happy to work with Michelle to set up a personalized demo of our software. No obligation, but we would simply show people this is what we can do to help make your life easier. Again, contact Michelle. She can set that up for you.
Great. Well, I just want to thank everybody again for joining us. Thank you so much, Neil, for the presentation. A lot of great information there. Just a reminder that we will be sending out a follow-up email tomorrow with a link to this recording. And if you do have questions about what we talked about today, like Neil said, please feel free to contact either Michelle or Neil, and we will get that answered for you. So until next time, I hope everybody has a great afternoon.